Hello everyone, and welcome back to another deep dive into the world's most pressing issues. The US-Israel military operation against Iran that kicked off on the 28th of February 2026, dubbed Operation Epic Fury. This isn't just a regional skirmish, it is sending shockwaves through the global economy. From skyrocketing oil prices to potential recessions, this conflict could hit your wallet harder than you think. I am going to break it down step by step, explaining the immediate impacts, the broader risks, and what it means for everyday people like you and me. You won't want to miss this. Let's start with the basics. What happened? In late February, the US and Israel launched coordinated strikes on Iranian nuclear facilities, ballistic missile sites, and even key leadership targets. Tragically, this included the confirmed death of Iran's supreme leader, Ayatollah Ali Khamenei, in airstrikes on Tehran. Iran retaliated, fiercely firing missiles at US bases, targeting Gulf energy infrastructure, and attempting to disrupt the Strait of Hormuz. That is a narrow waterway that carries about 20% of the world's oil trade. Right now, shipping is halted in parts of it, airports in Dubai are damaged, and explosions continue in western Tehran. The US has warned of more strikes, while Russia and China condemn the actions. This isn't just war, it is a high-stakes game with global stakes. Why does this matter economically? Energy is the lifeblood of the modern world. The Strait of Hormuz is like the artery for oil from Saudi Arabia, Iraq, and the UAE. Disruptions here mean immediate pain at the pump. Brent crude oil prices jumped from around $60 to $70 a barrel to $80 to $120 overnight. Natural gas prices spiked too, especially in Europe, because Qatar LNG exports are bottlenecked. For context, every $10 increase in oil can shave 0.1 to 0.2% off global GDP growth. That is trillions in lost economic activity. No. Let's zoom out to the immediate market reactions. Stock markets worldwide went into a frenzy. The S&P 500 dropped 1 to 3% in volatile trading as investors rushed to safe havens like gold, which surged 5 to 10%. The US dollar strengthened, but currencies in emerging markets, think India, Brazil, weakened under the pressure. Why? Risk aversion. No one wants to invest in shaky economies when war looms. Sectors are hit unevenly. Winners, defense companies, and non-Middle East oil producers like the US, Russia, and Australia. They're seeing higher prices and bigger market shares. Losers. Airlines and shipping firms are in chaos, flights cancelled, insurance costs through the roof. Tourism in the Gulf could plummet, and logistics chains are strained. Imagine your Amazon package delayed because ships are rerouted around Africa, adding weeks and costs. On inflation, higher energy prices mean everything gets more expensive. Transport, food production, manufacturing, it all cascades. Analysts say this could add 0.5% or more to global inflation if oil stays above $100 a barrel. In the US, gasoline might rise 10 to 30 cents per gallon initially, but in energy importing regions like Europe and Asia, it is worse. China, a massive oil buyer, is already feeling the pinch, which could slow their factories and exports. What about global growth? If this conflict stays contained, say, wrapping up in 1 to 2 months, the drag might be minimal, just 0.1 to 0.5% off 2026 GDP forecasts. But if it escalates, proxies like the Houthis in Yemen or a weakened Hezbollah ramp up attacks, or if the strait closes fully, we're talking $100 plus oil for months. That could tip the US into negative growth, raise unemployment, and spark recessions in vulnerable spots. Think about supply chains. Gulf ports are key hubs. Disruptions mean stranded shipments, higher freight rates, and potential food shortages in the region within weeks if maritime traffic drops 50%. Globally, this amplifies existing woes: trade tensions from US tariffs under Trump, high interest rates from central banks fighting inflation. The Fed might hold off on rate cuts now, looking through this short-term spike, but if growth falters, they'll slash rates fast. Fiscal impacts are huge too. The US has already poured $31 to $34 billion into related aid since 2023, with these strikes costing nearly $800 million alone. Governments worldwide might see wider deficits as they subsidize energy or boost military spending. Let's make this personal. Expect local fuel prices to jump, making transport and farming costlier. Food inflation could worsen as global grain and fertilizer prices rise with energy costs. Currency depreciation means imports like electronics or medicine get pricier. Small businesses suffer first, but it trickles down to jobs and daily life. Broader risks. A prolonged war could fracture global trade ties, reigniting trade wars. Uncertainties. Energy volatility boosts alternatives like renewables, but in the short term, it is pain. Markets are pricing in containment for now. Oil spiked, then pulled back slightly, but experts warn of a tipping point in 2026, with US-led shifts in the world order adding fuel to the fire. Compare this to past crises. The 1973 oil embargo quadrupled prices and caused stagflation. The 1990 Gulf War spiked oil 200%. This could be similar if not contained, but with modern tools like US shale oil reserves, we might buffer some shocks. So, what are the scenarios ahead? Best case, diplomatic off-ramps work. Iran backs down, strikes end, and prices normalize. Volatility fades and economies rebound. Worst case, escalation draws in more players. Russia aids Iran. China protects shipping, leading to a broader Middle East war. Permanent Hormuz issues, cyber attacks on infrastructure, or even nuclear risks, though unlikely. That means global recession, fractured alliances, and years of recovery. Policymakers are scrambling. The US pushes America first energy independence. Europe diversifies away from Gulf gas, and Asia stockpiles for you and me. Hedge where you can, maybe invest in gold or stable assets. Cut unnecessary spending and stay informed. This crisis underscores how interconnected we are. A strike in Tehran affects a farmer in Tanzania or a factory worker in Texas. It is a reminder geopolitics isn't abstract, it is economic reality. Wrapping up, the Middle East crisis is a powder keg for the world economy. Immediate shocks in energy and markets, broader drags on growth and inflation, and risks of deeper turmoil. But with smart policy and diplomacy, we can navigate it. Keep an eye on updates. This is evolving fast. Thanks for watching this full breakdown. If you found it helpful, hit that like button and share with friends who need to know. If you want more in-depth analyses on global events, geopolitics, and how they impact your life, from economic forecasts to regional spotlights like East Africa, subscribe to Real World Files right now. Click the subscribe button below turn on notifications, and join our community of informed viewers. We've got exclusive content coming up, stalemate and US policy shifts. Don't miss out, subscribe today.